Hey traders, David Frost, LazyEMiniTrader.com. In this video, we're going to talk about what a market reversal looks like, specifically using Citigroup, letter C, which had a textbook daily chart reversal today, which is October 12th, 2017. The reason I'm making this video is because I think there are a lot of valuable lessons that can be learned from the activity that this stock had today, and also some of the things that led up to the reversal, and some of the things that we can identify on the chart that can be of value in other stocks, other charts into the future. First, let's define what a market reversal is. So there can be a reversal from a high, or there can be a reversal from a low. There are a few different ways to identify a reversal. Ideally, we're looking for a stock that gaps up early in the morning at the open and reverses finishing at the low, but not only finishing at the low of the day, but also taking out some important levels along the way and having what we call an engulfing candle. And an engulfing candle is a candle like you see on the chart, today's candle, which is the far right-hand candle. An engulfing candle is one in which engulfs either the last day's activity or the last several days' activity, which you see here. Today's down day in Citigroup wiped out about the last 10 days of market activity, finishing on the lows and also on heavy volume. As you can see on the bottom of the chart, the average daily volume in this stock is about 15 million shares a day. Today's volume was over 40 million shares. That's called a high volume reversal day, and very important as part of the definition of what makes it a reversal day. Now you can easily flip a chart like this around and have a reversal from lows. So a market can reverse after going down for several days, several weeks, even several months in a row, and have a high volume reversal day to the upside, and that's an indication that you can buy the stock expecting further upside activity. In this case, this is a pretty good and bona fide signal that we're going to see more downside activity in Citigroup. It may not happen right away, but when we do get reversals like this, it's generally speaking a high probability that we're going to get lower prices ahead in a stock like this. It could take a while, but in a case like this, I wouldn't be remotely interested to buy a stock like Citigroup after a reversal day like this until this stock first target would be $65.74. The second target would be $60.24. Until at least that first target of $65.74 was hit, I'm not looking to buy this stock with anybody's money, let alone my own. Now, there are certainly support areas along the way in between where the stock is now and $65.74. We're not going to get there in a straight line, but I'm going to show you at least where I got that number from. The picture becomes much more clear when you increase the time frame we're looking at to a weekly chart. And by the way, in a minute, I'm going to show you why the stock hit a resistance point and why it wasn't a tremendous surprise that we got a market reversal today. I'll show you exactly where that number came from, where you see the purplish line or pinkish line running across the top of the screen. That was actually a pretty easy resistance point to pick out. Let's get back to the support areas and where these numbers come from and why they're important. The first way I come up with these numbers is through very simple mathematical calculations. Those are taught in my course at LazyEMiniTrader.com. But the second way I know these numbers are important is when those mathematical calculations come out to an area where the chart is already telling us that those price levels are important. It simply reinforces the importance of the mathematical calculations. This area right here, where the stock did what we call consolidated for about 3 months' time back and forth in this zone. And you can see here that as it turns out, the $65, $75, $65, $66 area in this neighborhood was supportive of the market this entire time for that 3-month period of time. The stock was consolidating, building energy to make another move higher right into this level that was resistance. So if the stock comes back to this area right around 65.74, and with a stock like this, these are exact numbers because they're mathematical calculations, but it's within 25 or 50 cents or even $1 if you're looking to buy the stock as a swing trade. But when the stock comes back down to this level, there's very good reason that same price level will be supportive of the market, just like it was supportive of the market or this stock for a 3-month period of time. The second level down below at $60.24 is much of the same story. You can see how the stock rallied up to or around that number, found resistance, pulled back, tried it again, found resistance, pulled back, finally broke out up to the next level at 65.74, give or take. The $60.24 is the mathematical calculation, and the general area is where we would be willing to buy the stock, because if it did come back down to that area, there's a high probability the stock will be supported in and around that number. Why is this? Well, specifically on a stock like this, it has very large institutional ownership. And what that means is that the institutions, such as mutual funds, the big banks, index funds, hedge funds, pension funds, all these large institutions, the big money, the smart money, they're already telling you based on the chart where the important price levels are with this stock. You can tell in here where the stock consolidated for 3 months, that was institutional accumulation of the stock. These areas are where the institutions were not buyers of the stock, and in many cases were sellers of the stock. Specifically on the left-hand side where there were big sellers of the stock, and the two areas on the right where it was what we call institutional distribution, where they were selling or taking some profit in the stock as well. That's why chart resistance takes place when the big money are net sellers of a stock, as opposed to the consolidation point where they were accumulating the stock. That's the chart's way of telling you higher prices are coming. Now we're back on the daily chart, and before I mentioned the resistance point for the last 6 trading sessions, including today. Why was that price level resistance, and where did it come from? Well, I'm going to show you, and it's a lesson right out of my course at lazyemineytrader.com. Now we're on a very long-term monthly chart of Citigroup. And it looks completely different than the daily and the weekly chart. It's a pretty ugly chart. And one of the reasons is because in the 2008 into 2009 market crash, where it topped out in October of 2007, meaning the market did, Citigroup actually topped out before that, all the banks got crushed in that credit crunch and market decline. Since then, Citigroup actually had a reverse split, which is why this chart shows a high of about $570 a share. But that's not what's important. What's important is, where does the $75.85 number come from? As the stock traded along for the last several years, it started to edge up closer and closer over the last couple of years to what I call as this red candle high, which comes in at $75.85. That is a monthly high, and this was also a big down candle. If you look at the high of this candle at $75.85, the low comes in at $28. So this is what we call a big breakdown candle. That was in January of 2009, getting close to the bottom of the market crash that occurred in the beginning of March. So over the last couple of years, as Citigroup began to creep higher and higher, and it got close to the top of that red candle at $75.85, it was a pretty good bet. It was a high probability that that was going to, at least for a temporary basis, if nothing else, create a resistance point to this stock. Markets like to test the highs of breakdown candles and also the lows of breakout candles. This one is a breakdown candle. It tested the high, and what we saw today was a market reversal away from the high of $75.85. This isn't something just specific to Citigroup. This is inherent on all charts, all time frames, all stocks, futures contracts, forex, exchange traded funds, commodities. It doesn't matter. All charts act and react the same way. This is just a little snippet of the wide variety of technical chart analysis that I teach in my course. Everything I teach can be applied to any chart, any time frame, and it matters not what the name is on the chart. We're on a 10-minute chart now, and remember before, earlier on in the video, I discussed that a bona fide reversal is typically when we see a stock gap higher in the morning and reverse and trade lower for most of the day, finishing at the lows of the day. Well, you can see here that the close from yesterday, the closing price was $74.93. The stock opened today higher, opening the day at $75.82 after the earnings announcement. It traded to a high of $76.14 and immediately reversed and trended lower all day, putting in a market reversal. The stock got no higher than 29 cents above the high from January of 2009 breakdown candle. If you want to learn a lot more information like this, then come over and visit lazyeMinitrader.com and you can learn how to read the charts, any time frame, any chart, anything you wish to trade. I hope this was a valuable lesson and you're able to take away information that you can use to your advantage into the future to enhance your trading success. I'm David Frost, lazyeMinitrader.com. Thanks for tuning in, folks.